Welcome to the deep dive.
Okay, so you've got the latest from Tilray Brands here. Their Q1 fiscal 26 results ended August 31st, 2025.
That's right.
And Tilray, well, they're this big global player, right? Lifestyle, consumer goods,
Right.
cannabis, beverage, wellness, the whole package.
A complex beast.
So our job today, basically, is to quickly unpack these numbers, see if the financials actually back up their, strategic talk. Is it working where it counts?
Absolutely. And with a company that's grown like Tilray has through all those acquisitions in such a fast-changing, regulated space, these financials, they're more than just a score. They're kind of a map.
A map showing if they've managed to actually stitch it all together effectively.
Exactly. And sometimes we're hunting for the good news, but this time, it kind of leaps off the page. Two numbers especially. They really frame this quarter as, well, a potential turning point.
Okay, well, I'll kick off with the top line then. Pretty strong headline there. Record Q1 net revenue hit $209.5 million.
Yep, record. That's up, what, 5% from the $200 million last year, same period. So growth is happening. The diversification seems to be pulling in sales volume.
It does show volume, but if revenue's the volume story, the profit swing, that's the strategic story. They did something genuinely significant here. They reported actual net income. $1.5 million.
Under GAAP, right? The official number.
Under GAAP, yeah. And you have to remember the context. Same quarter last year, they posted a net loss of almost $35 million. $34.7 million to be exact.
Wow. So that's a swing of nearly $36 million.
Yeah.
From deep red to black in just a year.
That's the turnaround. That's the big headline, I think. GAAP profitability.
Okay, right. Let's unpack that turnaround because, $1.5 million net income, it might sound small for a company this size, but the shift itself, that momentum feels huge. It wasn't just luck. Right?
Oh, definitely not luck. It points to a really intense focus on the expense side of the equation. But hang on, before we dive deep into costs, let's just touch on their adjusted net income too.
Okay, how did that look?
Also much better. It came in at $3.9 million. Now, compare that to last year's adjusted loss of $6.1 million. That's a $10 million improvement year over year on that adjusted basis.
Right. So the official GAAP number is a bit lower, probably some, non-cash stuff or one-offs they adjust out. But either way you slice it, the trend is definitely positive. Big improvement.
Precisely. And their main operating metric, adjusted EBITDA, that was up too. Increased 9% to $10.2 million from $9.3 million last year.
Okay, so positive momentum across the board.
Mm-hmm.
But you mentioned that focus. The CEO talked about disciplined execution. Do we actually see proof of that discipline in the numbers? Or is that just, standard CEO talk?
No, the proof is definitely there. And it's quite stark, actually. The most amazing one, I think, which says a lot about their M&A history, is the amortization expense.
Okay, what happened there?
It dropped, wait for it, 82%.
82%.
Yeah. From over $21.8 million last year down to just $3.9 million this quarter.
Whoa. Okay, 82%. That's a massive cut. But why is amortization such a big deal for Tilray specifically?
Well, because amortization, it's how companies account for intangible assets, things like brand value or goodwill that they record when they buy other companies.
Right, acquisitions.
And Tilray did a lot of acquiring, so they had huge amounts of these intangible assets on their books. A massive drop like this suggests they're finally done writing down the value of past deals. Maybe some assets weren't performing or were overvalued initially.
Ah, I see.
Yeah.
So they basically finished cleaning up the financial mess from their big shopping spree, taking the write-offs. And now the actual operations can show through without that drag.
That's exactly how I read it. They've cleared the decks. And that discipline, it wasn't just amortization. Restructuring costs, down 80%, from over $4.2 million to under $900.
Okay.
You put those together, and overall, total operating expenses fell by a huge 42%.
42% reduction in OpEx. That's serious cost control.
It really is. It proves they're building a much leaner, much more sustainable business. That expense control is absolutely fundamental to how they swung from that big loss to a profit.
That operational efficiency story naturally leads us to, well, cash flow and the balance sheet, which is always critical, right?
Yeah.
Especially in this industry. Are they funding themselves now?
And this, for me, is maybe the most impressive number in the whole release. Their cash used in operations.
Okay. How did that change?
It improved massively by $34 million. Think about it. Last year, they burned through $35.3 million just running the business day to day. This quarter, they only used $1.3 million.
Wow. So they're basically right at break even on operational cash flow?
Practically neutral, yeah. And that is incredibly important.
Why is that? What does it unlock for them?
It just gives them breathing room, huge flexibility.
Yeah.
It means the core business is essentially paying its own way now. They don't have to constantly raise money or sell things just to keep the lights on.
Right. That makes a huge difference strategically.
Absolutely invaluable.
And the balance sheet itself reflects that improved health.
It does. They reported a nice, solid cash balance, $264.8 million.
Okay, nearly $265 million in cash.
And they're actually paying down debt, too. Reduced total outstanding debt by about $7.7 million just in this quarter.
So, strong cash pile, less debt.
Which leads to this. Their net debt. It's down to only $4 million.
Just $4 million. Net debt.
Yep. And the key ratio here, the one that really shows their financial muscle, especially for this sector, net debt to their trailing 12 months adjusted EBITDA. It's down to a super low 0.07x.
0.07 times.
Yeah.
That's almost nothing. You hardly ever see that, especially in cannabis or related industries. They're barely levered at all.
It's incredibly low. It basically means they're, like, financially rock solid right now.
So, okay, here's the question then. If they have almost $265 million in cash and virtually no net debt, why haven't they been more aggressive on the M&A front recently? Are they just being super cautious? Or maybe waiting for something specific like, U.S. federal changes?
That is the multi-million-dollar question, isn't it? That low leverage and that huge cash pile mean they don't need to rush. They can afford to be patient. Very ticky. They can wait for the right opportunity, maybe wait for those big regulatory dominoes to fall, like potential U.S. federal legalization or maybe further liberalization in Germany. A big move there could totally change the game.
And the CEO hinted at that, right? Saying that cash gives them great flexibility for strategic opportunities.
Exactly. It sounds like they're definitely looking, but they're waiting for the perfect shot, not just any shot.
Okay, so fantastic financial picture overall. Really strong turnaround driven by cost cuts. But now we need to pivot. That $209.5 million in revenue, it comes from 4 different areas, right?
Yeah.
Cannabis, distribution, beverage, and wellness.
Yep, the 4 pillars.
We need to know where the actual quality growth is coming from. Which segments are pulling their weight on profit, not just volume.
Okay, let's break down that revenue mix. And what jumps out immediately is how diversified they are now. The biggest slice of the pie. It wasn't actually cannabis this quarter.
No. What was it?
It was their distribution business. Pulled in $74 million. That's 35% of the total net revenue.
Right, and that's mostly the German medical distribution arm, CC Pharma, isn't it? Kind of a high-volume, lower-margin business.
Exactly right. High volume, thin margins. After that, you've got the core cannabis business at $64.5 million. That's about 31%.
Okay.
Then the beverage business, think Sweetwater beer, and the spirits at $55.7 million, so 27%. And finally, the wellness segment, that's the Manitoba Harvest stuff, at $15.2 million, or 7%.
Okay, let's challenge that mix a bit. If distribution is your biggest segment, 35% of revenue, but it only makes an 11% gross margin.
And that margin actually dipped slightly from 12% last year.
Right, dipped to 11%. Doesn't that kind of dilute the quality of that overall $209.5 million revenue number? How much of that growth is really adding meaningful profit?
That's the core strategic trade-off they're managing.
Right.
That distribution segment, yeah, the margins are thin, but it provides enormous scale and, crucially, stability. It smooths out the bumps you inevitably get in the highly regulated, volatile cannabis market.
So it's a stabilizer, a volume play.
It's definitely a volume and stability play. But yeah, if they lean too heavily on it, it does drag down the overall company profitability profile.
Okay. Let's turn to cannabis then, the original core. Revenue there was up 5% to $64.5 million. Where did that growth come from? And what was the cost?
Well, the growth was pretty broad-based within cannabis, actually. Canadian adult use gross revenue, up a strong 12% year over year.
Okay, strong in Canada.
And international cannabis revenue grew 10%. So their whole global cannabis leadership idea, it seems to be translating into actual market share gains and volume. They've specifically mentioned keeping that #1 spot in Canada by revenue.
Right. But there's always a but. What happened to the profit margin in cannabis?
Yeah. That's the trade-off. The cannabis gross margin, it dropped. Went from a pretty healthy 40% last year down to 36% this year.
Ouch. A 4-point drop in gross margin on your core high-margin product. That's significant.
It is significant. And it suggests, they're likely prioritizing winning that market share, getting that volume, maybe overholding the line on price.
So competing aggressively on price. Or maybe shifting the mix towards, cheaper bulk or value brands.
Could be either or both. The Canadian market is super competitive. But yeah, the bottom line for you, the listener, is that this top-line canvas growth came at the cost of some segment profitability, which puts even more pressure back on those company-wide cost cuts we talked about to deliver the overall profit.
And we saw similar margin pressure elsewhere too, didn't we? The beverage segment.
Yeah.
Revenue is basically flat, slightly down actually, at $55.7 million, but the margin there also slipped.
Yep. Beverage gross margin went from 41% down to 38%.
So even the higher margin businesses are finding it tough to maintain pricing.
Seems that way. The only segment that really held firm on margins was wellness. Revenue was up slightly to $15.2 million, and the gross margin stayed stable at a decent 32%.
Okay, so let's sum up the segments. Revenue growth driven mostly by distribution volume and cannabis volume. Right.
But margins took a hit in 3 out of 4 segments: cannabis, beverage, and even slightly in distribution. The only reason they posted that GAAP net income was because of those massive cuts to operating costs.
That's the story in a nutshell, yeah. Management fought off those operational headwinds and the margin squeeze through really tight financial discipline and cleaning up the balance sheet legacy issues.
Which brings us back around to their outlook. Management sounds pretty bullish. They reiterated their guidance for the full fiscal year 2026. Adjusted EBITDA target of $62 million to $72 million.
Yeah, that's a pretty confident forecast.
It is. Given the margin pressures we just discussed, what do they need to do to actually hit that $62 to $72 million target?
Well, 2 main things, I think. First, they absolutely have to keep that cost discipline going. They can't let those operating expenses creep back up.
Yeah.
That 42% cut needs to stick, or mostly stick.
Okay, maintain the cost control. What else? Second, they either need to stop the bleeding on margins, especially in cannabis and beverage, or ideally start to improve them again, maybe through new products, innovation, getting more efficient.
And that big cash pile gives them options to invest there.
Exactly. That $264.8 million gives them the firepower to invest in things that could boost margins, whether it's branding or innovation or maybe even small, smart acquisitions that help vertically integrate. They need something to push those segment margins back up to hit that aggressive EBITDA number.
Okay, so let's wrap this up. What's the final health check on Tilray based on this quarter?
I think the biggest takeaway is that fundamental shift in financial stability. They proved they can turn a GAAP profit, which is huge. They did it while growing the top line and radically improving their cash situation.
So they turned the corner. But
that profitability right now, it feels like it's driven more by fixing past problems, those huge cost cuts, the amortization cleanup, rather than by pure unadulterated strength in their core business margins.
right. And you also have to give credit to the diversification strategy, though. It seems to be working, at least in terms of stability.
Oh, definitely. Even with those margins contracting in cannabis and beverage, having the other pillars, especially distribution, meant they still hit record revenue overall and scraped out that net income. They've got multiple engines now.
Okay, so that leaves us with a final thought for you, the listener, to ponder.
Right. If their biggest revenue driver, distribution, brings in $74 million but only makes an 11% gross margin, while their strategic core, cannabis, makes a much nicer 36% margin, but that margin is shrinking. What's the real plan to hit that $62 to $72 million EBITDA target?
Yeah, what's the underlying bet? Are they banking on a big recovery in those high-margin segments? Or are they figuring the sheer volume and stability from the lower-margin businesses will be enough to carry them there, even if the high-margin stuff stays pressured?
That's the strategic tightrope they have to walk. How do they balance volume, stability, and profitability across such different businesses?
Yeah.
Something to watch, for sure. Okay, thanks for diving deep into these Tilray results with us.
My pleasure.
We'll catch you on the next one.